Good afternoon and welcome to our webinar today. Today's topic will be HSAs, Medicare, and 401ks, how they interact. We'll welcome our guests today. First of all, we've got Whitney Johnson. Whitney is one of the founders of HSA Resources. Whitney has written and presented on the topic of HSAs in many arenas, which has provided him the opportunity to hear and answer a wide range of questions from HSA custodians, employers, and individuals. Whitney is an associate professor at St. Cloud State University, where he teaches business law. Jim Spaniel. Jim has over 30 years in the financial services industry. He has an undergrad degree in history from the St. John's University. Jim started his career at Wolters Kluwer Financial Services, formerly known as Bankers Systems, as a retirement plan consultant and team leader managing the seminar and consulting area. Jim continues to share his HSA expertise via webinars and presentations throughout the United States. Bridget Faber is the partner and director of employee benefits at Mahold Insurance Agency here in St. Cloud, Minnesota. Bridget is a graduate from the College of St. Ben's. She has over 16 years specializing and consulting and educating strategic planning of employer benefit programs. My name is Stacy Graham. I will be your moderator today. I have been involved with banking and customer service for over 15 years. I'm involved with the daily operations of the health savings accounts, ensuring that customers have a great knowledge of how their HSA account can work for them. HSAs, Medicare, and 401ks, how they interact. Our agenda today: people are living longer. People are living longer. They need to save more. Healthcare costs and retirement. HSAs can help. Employer HSA issues for age 65 employees. Continuing HSA contributions after age 65. The use of HSAs for Medicare premiums. And Jim will start us out today by talking about how people are living longer.
Thank you, Stacy. We're hailing from St. Cloud, Minnesota, land of 10,000 lakes and billions of mosquitoes. A little background data on Minnesota alone, profile of older Americans. So we've got a quick quiz. What event is predicted to happen in 2020 that has never before happened in the history of the state of Minnesota? A, Minnesota Vikings will win the Super Bowl. Yeah, right. B, Minnesota will have more immigrants than U.S.-born residents. C, Minnesota will have more 65-plus residents than school-age children 5 to 17. I think we all know that answer. We're all getting older. C is the correct answer. So let's talk a little about the aging workforce. First of all, when you look at our two biggest entitlements, we've got Social Security and we have Medicare, which really represents 42% of our federal expenditures. Now, we've got a lot of things to consider. You know, we have a shrinking workforce due to retirement, health issues, aging out due to skill deficiencies, and caregiving. A lot of people have to retire early just to caretake their other partner, for example. Healthcare costs can clearly unravel anyone's retirement. Most financial planners today will tell you to replace the income you want when you retire. Your goal is to replace 70 to 85% of your pre-tax income. And some now are saying you probably need 90% to make up the healthcare costs that a lot of us thought was going to be taken care of through the Medicare piece. You know, and you look at income replacement, our number one source for many people is going to be Social Security. And then, of course, we've got retirement accounts, which could be defined benefit pension, 401ks. We have personal savings, got inheritance perhaps for those lucky people out there. And for some of us, we might have to work all our life just because we didn't replace enough money. Reality is, when you look at Social Security alone, which is probably the number one income replacement for most people, an individual receiving about $25,000 in benefits per year, according to healthwealth.com, they feel it may consume up to 60% of that benefit for that Medicare piece. And in another 10 years, it could be up to 90% of that entitlement. So we all know that Social Security isn't going to be enough for our income replacement. We need to do more asset allocation to our 401k when we retire, and because we need to manage those dollars longer. What we certainly do know is that individuals are living longer. current life expectancy is almost 80 years old. You have a 50% chance, at least one member of a 65-year-old couple, to live beyond 88. And you have a 25% of one living past 90, and 1 out of 10 can live past 95. We have 10,000 baby boomers who are turning 65 every day. And by 2030, all baby boomers will be 65, which will be 18% of our total population. Speaking on a personal level, my wife's grandparents on both ends both lived to 104. So she's clearly worried about outliving her income, much less the health care costs. And again, as Debbie's always said, if she looks at me retiring, she thinks she's going to have twice the husband and half the paycheck. So she clearly would like me to work a lot longer than the normal retirement age. By 2030, Medicare will likely cover only 86% of those costs today. And again, living another 20, 30 years is a huge challenge for income replacement, much less what it's going to cost for healthcare costs, which exponentially can get higher as we age. Again, there's a great website I'd like you all to be aware of, Health View Services, that will calculate your healthcare costs. It takes into account your age, your income in retirement, your gender, current retirement accounts, and state of residence and filing status. And lastly, we also know that some of the Affordable Care Act, some of those dollars were taken away from Medicare to start that program. So we do have challenges. Looking at the next slide, the nationwide retirement survey by Harris Poll, 69% of the affluent pre-retirees say top fear is healthcare costs. And 63% of those affluent pre-retirees say they are terrified of what healthcare costs may do in their retirement. 53% talk to their financial planner, but only 10% of them discuss healthcare costs. And 40% of financial planners are still not very aware of these costs. We're going to show later how Medicare expenses certainly doesn't cover everything. It's not going to cover dental, vision, out-of-pocket expenses, deductibles. And of course, game changers in this could be huge health expenses relating to heart disease, diabetes, lung disease. There's very expensive drug therapies that some people have. Chronic health problems can be a game changer in this financial issues we're dealing with. End result is we need to create a plan to address these healthcare costs.
For many of the employers that are on the phone today, you can tell just by your demographics that employees are working longer. They're working well beyond Medicare eligibility. And with that comes some complications and education opportunities for employers. From my standpoint, we look at our book of business of clients, and about 60 to 65% of our clients have an HSA program in place, either as its only option or as a dual option. We are seeing HSAs and high deductible health plans really soar. They've been around for about 12 years, and over those 12 years, certainly the tools and resources that are available have grown and really have been a key to education with employers. From your standpoint, though, because employees are working longer, this is a great opportunity for you to engage employees. Getting that education, getting them out there to really understand insurance, understand the terms, and then understand the tools that are associated will help you long term, but also help those aging employees in understanding those tax benefits that are associated with HSA. So going back a little bit on the next slide, you'll see that I alluded to the fact that HSAs have been around for about 12 years. What happened initially is employers started putting in HSA accounts to really help impact the high increases of insurance costs that were happening at that time. What didn't happen, though, is it didn't change the behaviors with implementing those. So over the years, as HSAs have grown, the tools have grown, the insurance carriers have become more savvy in helping with that education, we're starting to see the behaviors of employees start to change. Our millennials, again, we have a wide variety of individuals that are at our workforce. We've got the millennials that want everything on their phone. They want everything to be online, being able to do some cost checking, all the way to the other spectrum of employees that are those Medicare eligibles, those baby boomers that want to be able to still have that paper in hand and be able to talk with someone, to be able to understand their benefits. So as we go through this and the education increases, we may have missed opportunities in the past to impact the behaviors of those employees. So as an employer, what we are really suggesting to our clients and to those that have HSAs is to start that education early and more often. It can't just be at open enrollment time. It really needs to be out throughout the year. Getting people engaged is then going to impact how they're able to use their claims, impact the claims that you have, but then also provide long-term knowledge for what's going to happen with your workforce. So as you know, Stacey's going to go to the next page, we'll see that there is some components that with HSAs, the IRS really guides where we're headed. The IRS sets the limits that are for our deductibles, the contributions, and so on this slide you'll see for both 2015 and 2016, the individual minimum deductibles that need to be in place in order for an individual or an employer to offer an HSA compatible program. Now, we have a lot of employees that come to us and say, gee, I have a high deductible health plan, and simply by thinking they have a high deductible does not automatically indicate that you can have an HSA program. The ability to have an HSA program open really comes around the plan design, and obviously the deductible level is one, but the other item is those expenses all need to go to the deductible. So we really eliminate copays, we eliminate really some of those prescription copays that are associated with traditional plans, and everything comes up to the deductible and then is typically cost shared with the insurance company. But there are minimums, and then of course there are maximums as well. The IRS dictates how high an insurance program can be, and that's also tied to the Affordable Care Act. In addition to the deductible levels, however, we also have HSA contribution maximums. So the very nice thing about HSAs and what employees really like about HSAs is that you can determine when you put in those monies, when and how much you put into those monies, but the maximum that you have for 2016 on an individual level is $3,350, and for family it's $6,750. For any individual that's over age 55, just like a 401k catch-up, you have the ability to do additional $1,000 catch-up. But again, the flexibility of being able to change those amounts throughout the year is really important. Unlike our flexible spending account where you have to determine what that amount is at the beginning of the year, the HSA really becomes flexible and allows those employees to determine when they want to put those funds in.
Hi, this is Whitney Johnson, and I get some time here to talk about the HSA features. You know, and HSAs first started in 2004, and a little background on our company is we started in 2004 as well. So we got started right when the HSAs got started, and in that time, HSAs have grown to 16.7 million HSA owners, about $30 billion in assets, and they saw about 25% growth last year, and that's roughly the same growth they've seen in the preceding 11 years, and people are projecting about 22% growth this year. And I guess that story is basically they've taken some time to get up to speed, but they've become mainstream and they've consistently grown year after year. And you know, we think that's because it's a good account, it's a good solution. We got into this believing in consumer-directed healthcare, and really that is a newer term. It's been around for 12 years, but the idea is that consumers should be involved in some of the financial decisions regarding health, and if consumers are put in charge of their own money, they might make better decisions with their money, and it might result in better satisfaction for them and better use of the money in the entire industry. And we think that works. With that background, however, the way that the government did this was tax-driven. So the HSA accounts are largely tax-driven. That means the IRS is the primary regulator, and it means a lot of the benefits are focused around taxes. And that sometimes gets a little boring for people, but on features I want to talk about first is this triple tax break, because that's really the main benefit of an HSA. And the tax breaks that most people think about is going in, the HSA contribution is tax deductible if made by the individual, or it's just actually tax-free if it's run through the company. That's a huge break. That's a similar break to health insurance premiums paid for by a company or a 401k contribution, but that's really the big deal about an HSA. You also get tax-deferred earnings. As long as the money sits inside the HSA, any growth grows tax-deferred. And then the really big deal that makes this different from other types of tax-deferred accounts, the government uses a lot of tax-deferred accounts. They don't very often allow you to take tax-free distributions. Sometimes you might hear about a Roth IRA or Roth 401k. That allows tax-free distributions, but the government got its take on the front end because you don't get a tax break going in. The HSA really combines both. You get the tax break going in, so you get the deduction going in, and you get tax-free going out as long as you use it for eligible medical expenses. And I want to talk a little bit more about what makes HSAs unique. It compares kind of to an IRA or a 401k, but a lot of people look at HSAs like a health plan. And if you compare it to an FSA and an HRA, this ownership, I like to focus on ownership because if you think of you own the HSA, that's really what makes the HSA unique in the healthcare industry. And what does ownership mean? Well, it means you can name beneficiaries. So in like a flexible spending account or a healthcare reimbursement account, the employer generally doesn't allow you to name beneficiaries. You might on an HRA, but they don't have to. But an HSA is your money, and if you don't spend it and you actually pass away, you can turn it over to your beneficiaries. You get to choose investments. Other types of health insurance or health plan for payments don't allow you to invest the money. You can choose who is your HSA provider. The employer may make that choice initially, but if you build up a balance, you can transfer it anywhere you want. You can move it to another HSA. You can decide whether to spend or save the money. And HSAs, as you get into it, on a professional side, you learn they're spenders and savers. There's some people that put their money into the HSA, and they virtually save all of it. Maybe because they don't have many medical expenses, but I think more likely because they see it as a good account to store money. And Jim's going to talk more about that later. A lot of other people spend it. As soon as they put the money in, they spend it, or they wait until they have a known medical expense, add some money to the account, and then spend it right away. And it works well for both people because they're the owners and they can decide. It's got incredible flexibility, as I've been mentioning, but one of the things I like to talk about is you can use the timing. You have a lot of flexibility on timing for when to use the money. And the obvious one on timing is you can build up a balance today and then use that money to pay for medical expenses you incur in retirement after you've retired and gone on Medicare. And we're going to talk a lot about that because it's a huge benefit of the HSA. And it's kind of obvious. But the flip side is not as obvious. If you have a really large medical expense today and you're covered by an HSA, but you don't have enough money in the HSA, you can actually use future years' contributions to reimburse yourself for a current year's medical expense. This flexibility allows for incredible tax planning where really somebody who does some careful planning will never have to pay for a medical expense with after-tax dollars because they can use their HSA by planning, by using in years of drought, they'll have to save receipts and pay themselves back. In years when they save a lot of money, in years of plenty, they'll save that money for the future when they really need it. You get to decide how to spend the money. Some people like to go to doctors, others might go to a chiropractor, maybe you go to homeopathic medicine. You can go to a doctor that's out of the network. It might cost you more, but it's your money, you get to decide. So that's part of this ownership. You don't have to tell your employer where you went. The HSA receipts are private. You may need to share them with the IRS, but you don't need to share them with your custodian. You don't need to share them with your employer. That's nice for some people that don't want to turn in receipts to their employer. You can make a contribution on your own. It's your account. In a lot of other types of medical spending accounts, you have to have an employer that's sponsoring the account. With the HSA, that's not necessary. If your employer only offers the high deductible health insurance or your employer offers no insurance at all, you can go out, buy a high deductible health plan, make the HSA contribution on your own. And that comes in handy even if the employer does allow for contributions because you can make a contribution after it's too late. A lot of times accountants will tell somebody they should have done a larger contribution while they're working on their taxes in early, let's say, 2016. And there's still time to do that as long as it's before April 15th. The account stays with the individual even if they separate from service. So again, some of the other medical accounts people are used to is when you separate from service, you kind of clean up your account and you're done with it. That's not true with an HSA. I also want to focus a little bit on age 65. A lot of this webinar or presentation is regarding age 65 retirement, and HSAs do have some special features for people that turn age 65. You can use your HSA for any purpose at age 65 without that 20% penalty. You will still pay taxes, income taxes, if you don't use it for eligible medical expenses, But paying income taxes on tax-deferred money is really the same treatment as an IRA or a 401k gets. So it's a pretty good treatment. It's what a lot of people are telling you, to max out your 401k because it's a good deal. Well, the HSA works like that. However, I think this panel would say, save it for medical expenses. You're going to have enough medical expenses that you will use your HSA for medical expenses, and the ability to use it for general retirement is nice, but probably not the right choice. Partly because you can also use your HSA at age 65 to pay for health care premiums. That includes most premiums you'd owe through an employer. So Jim talked about continuing to work past age 65. If you do that and you have to pay a portion of the premium, now employers often get a tax deduction on that anyway, so it may not be that helpful, or employees through an employer plan, but you could pay for that with pre-tax dollars. Maybe more important is you can pay for your Medicare premiums with pre-tax dollars. Most Americans are not going to be able to pay Medicare with pre-tax dollars because they will not have built up a sufficient fund in their HSA to do so, and there's no other way to do it. So this is the only way to pay, that I'm aware of, to pay for Medicare with pre-tax dollars. You can use your HSA for ongoing medical expenses. So after you enroll in Medicare, you're no longer eligible to make HSA contributions, but you can continue to use the HSA funds you've built up for eligible medical expenses. And Jim had some pretty scary numbers there, where we're all going to have a lot of eligible medical expenses that are not covered by Medicare. There's no 70.5 minimum distribution rules. You don't have to worry about forcing this money out. And the tax-free distributions, this is kind of obvious, but maybe not, is they don't add to your income. So if you are trying to meet income thresholds for other plans and other benefits the government may offer, it doesn't add to your income, so you're less likely to hit an income threshold. Those are a lot of key features on HSAs, but we have also a top 20 list that we have on our website that I want to make you aware of, and just kind of a general reference to our website. We have an employer resource center for employers, and we have an individual resource center for individuals. On those two resource centers, we have tools, and most of the material I'm going to talk about today are listed under tools. But there's a lot of good information out there, including our top 20, which goes through some more items. I wanted to talk a little bit now about comparing the HSA to a 401k plan. They don't often get compared, and often HSAs get compared to FSAs and flexible spending accounts and healthcare reimbursement accounts, which is what I've done. But really, I think if you look at this chart, if you had to make a choice between fully funding your 401k or fully funding your HSA, I think the HSA is a pretty clear winner. It's just a better account, really, all the way around. Now, there's some nits and we could talk about, but if you look at the chart, you know, the HSA has that triple tax benefit. The 401k does not allow for tax-free distributions, and that's the really big winner here. That tax-free, that's such a good deal that I think, again, if you're limited on your money to put in, the HSA should probably come first. You do have to wait a little longer. If you do want to use it for general retirement funds, it's age 65, where a 401k is age 59 and a half. But again, there's no required distributions, and you can use that money, you can use it to pay for eligible medical expenses tax-free. So overall, I think the HSA is really a better choice than a 401k. Jim, did you have some additional comments on that?
Yeah, thanks, Whitney. You know, to piggyback off this analysis, you know, there are other tools that obviously you can use to pay these medical costs. You know, you might have a Roth IRA that was rolled over from your 401k Roth. Those are already tax dollars, but it's not like the pre-tax HSA component. Some people have retiree health benefits provided by their employer. Some folks might have whole life insurance where they can tap their cash value. That's already taxed. Others might try to use a reverse mortgage. Non-qualified annuities where they have an exclusion allowance, where they can take a portion of their after-tax dollars, could be utilized. But in my opinion, and I'm biased like Whitney, I think nothing compares with the 401k versus rather the HSA component. And you know, as Bridget has said, we're working longer anyways. You're really only talking 5.5 years difference between the 401k at 59.5, where you can tap it, versus age 65 for the HSA, which you can tap it for any reason. But yeah, there are other tools, no doubt. Bridget.
Again, for the employers on the line today, you are seeing your aging workforce, and with that comes, or what we're hoping comes, more questions surrounding HSAs. What a lot of employees don't know is how the HSAs start to impact them when they turn 65. So we just want to take a couple slides and answer some pretty common questions we're starting to receive, and in turn encourage you to maybe start posing some of these questions to your soon-to-be retirees or those that may be turning 65. So the first question, I'll be turning age 65. Is there anything I need to do to prepare with my HSAs? And I would hope more people are asking this question, because what people don't understand is once you turn 65, if you enroll in Part A or Part B of Medicare, that automatically makes you ineligible to continue contributing to an HSA, or if you're an employer that contributes to an HSA, they cannot receive those contributions any longer. We occasionally will get the call where someone has already enrolled in Part A because that's at no cost to them, but are still receiving HSA contributions. And that becomes a bit of a stumbling block, because we either need to take the HSA contributions back out as a distribution, or try to go through Social Security and disenroll in Part A, which again has some complications to it. The other thing to think about for those individuals that are turning 65 are the contribution amounts. They need to be prorated for the year that they turn 65. And I know Whitney's going to go into that in a little bit more detail here in a couple of slides. But then the other item to think about is, if should anybody, which it might be a smaller population, decide to start drawing on Social Security, that draw on Social Security automatically enrolls someone in Part A, again making them ineligible for that HSA contribution. The second question is, I'll be turning age 65 soon, but plan on continuing to work. Is staying on the employer group plan a better option than enrolling in Medicare? And can I still contribute to my HSA account? So this is kind of the million-dollar question, and I'm sure several of you as employers may have had an employee come in wanting that help with making that decision. And that's kind of a fine line to walk, because as an employer, you cannot encourage anyone to enroll in Medicare, disenroll in a group plan to go on to Medicare. But truly, those employees are just looking for some guidance on which is the better option, probably financially, rolling into Medicare and having Medicare premiums versus a group premium, and offsetting any HSA contributions they may be able to get a tax benefit from. So there isn't a great answer out there. It really is going to be a personal decision, but as an employer, know that really the employee needs to sit down and look at the tax benefits versus the out-of-pocket costs that they're going to have to make that decision. The third one says, I've been enrolled in my employer's HSA program and will now be retiring and enrolling in Medicare. Medicare is asking if I have had creditable prescription drug coverage. What does that mean? So this question really, in the last couple of years, has come to the forefront because, as I noted earlier, the IRS plays some regulatory roles in HSAs, as it does with Medicare. And the IRS sets what Medicare Part D prescription out-of-pocket can be for an individual. And if there's an employee under a group plan, and typically it happens under high-deductible health plans, that when the out-of-pocket expense for prescription drugs is higher than what the Part D is, it becomes a non-creditable plan. And employees each year when they're on a group plan receive a notice in October from their insurance carrier letting them know whether or not they have creditable coverage or not. It goes directly to the employee's home. Many of them don't even open it or read through it, so they don't understand this until this question gets posed from Medicare. And should they be enrolled in a high-deductible health plan that has non-creditable prescription drug coverage, when it comes time to enrolling in Medicare and Part D specifically, there's a penalty associated with it. Now, it's a small penalty. It's about 34 cents right now per month, but it's per month for every single month that you continue to be enrolled in a employer non-creditable prescription drug program. And so if someone continues to work well after 65 and wants to have that HSA program under that high deductible, that dollar amount can kind of grow. And we just don't want it to be a surprise when they have that additional amount tacked onto their Part D premium. The other question that we had gotten in the past, which made it an obstacle for employees to participate in an HSA program through their employer, had to do with those that had access to VA coverage or Veterans Affairs coverage. On January 1st, this was kind of a bonus to HSAs. They changed their viewing in that previously, if you had access to VA coverage, and again, one of the IRS regulations with HSAs is that you can't have access to any other health coverage. You can't have dual coverage, and VA coverage was considered other coverage. As of January 1st, they've removed that obstacle, and now individuals that have access to VA coverage can also have an HSA-compatible program. A few other items that we're fairly, would be excited about, but I'm not going to be overly optimistic, but these are some of the legislation items that are on the table this year for HSAs that would, again, even enhance the HSA programs a little bit more. But many of you are familiar with the Cadillac tax that is being imposed or was supposed to be imposed in 2018. It has since been extended to 2020. The HSA contribution was going to be a part of that calculation, and they're trying to take that component out of it, because if that component was in it, it's going to deter employers and employees from adding to their HSA accounts because they could potentially be subject to that Cadillac tax. The other item on the line is allowing individuals that are enrolled in Part A to be eligible for the HSA. Again, that would eliminate that obstacle from auto-enrolling, trying to get out of it, and kind of dealing with that as our population of workforce grows. Allows active military in TRICARE to choose from an HSA. So right now you've got VA coverage. The other individuals that have access to TRICARE because they were active military, that is considered other coverage right now. Again, they would like to make that as an eligible opportunity to still have TRICARE and have an HSA program. We once would like to bring back those over-the-counter prescriptions as eligible medical expenses, and several years ago that was something we could do. It was taken out. They're trying to bring it back in. So again, those Advils, those Tylenols, to be able to use your HSA dollars for that, again, would be a benefit. And then the last item is just allowing meal replacement plans, weight loss and control, gym memberships, and nutritional supplements to be an eligible expense through the HSA program. So again, those are on the table. Should those come to fruition, we'll certainly let you know.
Okay, on this next slide, we're going to talk about some strategies. Whether you should be paying medical expenses out of pocket and building your HSA to pay for health expenses during retirement. You know, the reality is when you're working, you have more discretionary income. And there are many out there, as Whitney referred to, are savers in the HSA program. They are letting this thing compound, grow tax deferred, and they are using their already taxed money or personal savings to pay for those benefits. If you can do that, it's a great strategy. And clearly, we do have a good portfolio out there that are savers, and then they have enough discretionary income to pay for those expenses with their credit card with points, for example. But you know, we have an example of a person who needed $3,000 and decides to pay the medical expenses out of pocket and keeping that $3,000 on a tax-deferred basis. No doubt, if that individual's at the 25% bracket, they would need $4,000 in their own money to pay for that expense. However, there is an opportunity cost to that $3,000 that stays in the HSA, which will grow tax deferred, and again, potentially for many years. So those funds would be vital for the retirement piece when you're dealing with Medicare. There are a couple ways that some people actually want to control out-of-pocket expenses. Always use, there's one good website, healthcarebluebook.com, that will give you a good understanding of what you should expect to pay for a service in your area. So it's always good to shop. And another thing that can be possible is there are negotiators out there. If you found that you thought that expense was too much from that healthcare provider, there are negotiated services that can negotiate the cost down, perhaps. And that would be a win-win for you as well. Now, if we look at the next slide, and that's where I referred to it as an opportunity cost, if you didn't take that $3,000 from your HSA and you just kept it on a tax-deferred basis, what we took is a 40-year-old who kept his $3,000 or her $3,000 in the HSA, let it grow for another, 25 to maybe 30 years. At a 2% growth at age 70, that could be worth $5,400. And at a 4% growth, that could be $9,700. So those are significant dollars just for that one-time withdrawal that you didn't take. If you did that for several years, you can see the compounding effect of that opportunity cost. Now, in the next strategy you've got to look at, of course, is expenses for retirement. And again, you get a lot of challenges. Again, years ago, I think people looked at income replacement and they never put the healthcare component inside that. But you look at what are our expenses. Other will include housing, entertainment, food, transportation, anything that's really considered non-medical. It can be travel, whatever. But you know, a lot of strategy for that is maybe use your Social Security benefits, your 401k, your retirement assets for those non-medical reasons. There is probably going to be a 3% inflation index for all those kind of costs. So we've got to anticipate that. Now, the certainty of ongoing Medicare premiums is really going to be a huge discussion, as we're going to get into. That's where I consider the HSA as kind of like a Medicare premium account, because by using your HSA dollars to pay for the Part B and Part D premiums particularly, those dollars come out tax-free. If you're using your 401k or other retirement assets, that is going to be taxable to you. It's going to go into what I call means testing, and you might be ending up paying a higher premium for those Part B and D premiums. So by using the HSA component, that results in tax-free withdrawals. So a lot of things to consider. Use your retirement assets to reduce income replacement, and if you can, use your HSA to take care of the medical part. Or if you have a Roth, that's another possibility as well.
Quick question here. Back in 1999, approximately 18% of Medicare beneficiaries enrolled in private health plans, also known as Medicare Advantage. What percentage were registered in 2015? Jim?
And you can see the growth in these private plans for Medicare. And I can speak for what Minnesota has, and in Wisconsin in some areas, they call it U-Care for seniors. And this is people who have Medicare Part A and B, and it is considered private insurance called Medicare Advantage, or also called Part C in Medicare, the alphabetical soup as I call it, which contracts with federal government to administer Medicare Part A and B. It includes all benefits provided by the original Medicare plus more. You know, people enroll for simplicity. They have access to a larger provider network. When traveling, perhaps, there's some value in performance there. Obviously, like anything in life, there is no Santa Claus. There's going to be a premium if you get into the Part C Medicare component, which is, again, that private insurance. But it is create some better value, and there are ranges like anything else, ranging from value on to classic value, which range can be anywhere from $44 a month to $168 a month, but it tends to give you better coverage.
Jim will lead us in the next slide that talks about healthcare costs during retirement.
Thanks, Stacy. In this next slide, and again, you know, there are a lot of figures out there, and I don't want to overwhelm you. Nothing is really sealed in concrete. Some people are very healthy. They've got a great gene pool. They don't have money out-of-pocket expenses during retirement, but there are others that will. A couple good tools that I've seen is AARP has a healthcare cost calculator that will help you, assist you in what your potential costs are. And again, I reference to info@hbsfinancial.com. This is a very comprehensive healthcare calculator. And again, it takes into a lot of information about what your retirement income is, your gender, your marriage status and filing status, and what state you live in. But the end result is, many years ago, when Medicare started, and this is back 50 years ago, Medicare, there were very few people who were really on that component. I really never remember my mom and dad too concerned about healthcare costs when they were retired. And that's certainly not the case today. According to Fidelity Benefits Consulting, if you had two retirees at age 62, potentially they could have over $271,000 in medical costs that Medicare is not covering due to the premiums, the out-of-pocket expenses. Remember, vision care, dental care is not covered, long-term care insurance is not, nursing home insurance. So there's so many components that are out there that potentially can increase that cost. You can see in the next piece that if you retired at age 65, it could be $220,000. And the longer you wait for retirement, because you've still got your employer's health plan at age 67, it could potentially $200,000 in expenses. So a lot of challenges, no doubt. Now, in looking at the next slide, determining your medical costs, Medicare costs. Medicare, there is going to be a premium to Part B and Part D. But first of all, Part A is hospital coverage. And all of us know, as we are working, approximately 1.45% of our paycheck is paid into Part A. So basically said, there is no premium to that when you start collecting that. But Part A, again, will not pay for everything, depending on how long you're in that hospital. It can get very expensive. Now, the other component is Part B. This is your medical insurance, which provides non-hospital medical coverage. There are gaps for most beneficiaries. Now, the government pays 75% of that Part B premium, and the beneficiary pays the rest. But if you make more money, higher income beneficiaries, you will pay a larger percent, equal to 35, 50, 65, or 80% of that total cost, depending upon what you report on your adjusted gross income to the IRS. At a minimum, that is inflating, they claim, according to a healthcare website, 6% every year. And the minimum cost, when you look at that premium, for two 65-year-old married couples who potentially live for another 20 years, that alone will be over $50,000, that Part B premium. So that's a pretty costly issue. And that's assuming you're at the lowest tier. And remember, those dollars will inflate every year. Looking at the next slide, Part D premiums, prescription drugs, potentially $479. What I've heard is that can inflate at probably 8% per year. Medigap is another piece. Medigap is extra insurance that you buy from a private company to pay healthcare costs. It's not covered by the original Medicare, such as the co-payments and deductibles and possibly the healthcare traveling outside the United States. There are reasons to have Medigap. But it doesn't cover long-term care. You've got nursing home costs. And again, to be available to get Medicare Part A, you have to be under Medicare Part A or B. And if people already have Medicare Advantage, they cannot have a Medigap plan. General enrollment is 6 months from the first day of the month of you turning 65. And again, you should try to buy Medigap outside this window. There is no guarantee that you can be able to get that coverage. The rates could go up higher. So there's a price to that. Obviously, you can't use your HSA to pay the Medigap insurance to get tax-free. It would be taxable, but it's another component out there. Out-of-pocket deductibles, co-payments, co-insurance, that could be possibly $1,500 or so a year. And so the total, according to the Medicare.gov website, is potentially $5,000 per year per individual. Now, as I referred to before, the means testing can come into play depending upon how you're using your dollars to pay for the Part B premiums. As you can see in this slide, there are 5 different tiers of income that people are going to have to deal with. Now, again, the minimum amount for most of us will be $104.90, depending upon what your filing status is. Again, over 20 years with 2 couples at age 65, that's a potential $50,000 cost. And again, we're not adjusting it to inflation. With 6% inflation, we know that cost will go up. What happens is the government will take that right from your Social Security benefits. And you can actually reimburse yourself from your HSA for those costs, and that would result in tax-free. And as you can see in those tiers, those incomes go up every, there's a higher premium depending upon what your adjusted gross income will be. So a good tax person has to deal with it. If you're using your 401k, again, to pay for those expenses, that's going to go into your adjusted gross income. That could shift you up into a higher tax bracket. And again, you because they're subject to the means testing, you might be paying a higher premium. So a lot of challenges. That 2015, by the way, a little trivia pursuit, is based on the 2013 tax year. So there's always a 2-year look-back period to determine what that premium will be.
Very good. Thank you, Jim. Whitney will lead us into the employer contributions for 65-year-olds or older.
Yeah, and we've already covered a little bit of this, so I just want to dive on a little bit more detail because I think it is an important issue. And a common question is, kind of how do you handle somebody that's turning 70 or 65 if they're an employee of yours? And again, I want to refer to our website again. We have a age 70 or age 65 worksheet for individuals, and the purpose of that is that most people do enroll in Medicare when they turn 65. And that's any type of Medicare. So that we've talked a little bit about the different types, but any type, Part A, B, C, D, or Medicare Advantage would make you ineligible for an HSA. So that's the quick answer. The longer answer is really employers can make two types of tax-deferred contributions. They're really tax-free if the employer's making it into an HSA. One of them is a comparable contribution, which means the employer is just giving this money to the employees. It's kind of free money. That one should stop. There are some complexities in how that contribution is being made, but really a best practice is to make that contribution monthly. An individual will enroll in Medicare in a particular month, then they would stop receiving their HSA contribution that month. If you do contributions other than monthly or less frequently than monthly, there's a little bit more discussion that we'll save for another time. The other type of contribution is a payroll deferral through a Section 125 plan. That can also be done pre-tax. That one's a little more complicated. I think, again, the quick answer is the employee should probably stop making that contribution. But the more complicated answer is an individual really has until their tax due date to make their HSA contribution for a year. They can actually make a contribution to their HSA account after they're no longer eligible for a contribution, so long as they're making it for a period when they were eligible within the time frame. So if you flip to the next slide, it shows this situation. So Jim here enrolls in Medicare on July 1st of this year. Well, July 1st is convenient because it's exactly half of the year. So Jim can contribute half of his otherwise contribution. This is considered a pro rata contribution. I'll let you work through the math in detail, but basically a full contribution for somebody that year would be $4,350. Bridget read that number earlier. Plus you get $1,000 catch up for the age, so that would be combined $4,350. I divide that by 2, it's $2,175. So if Jim had been contributing, $100 a month through payroll deferral, which is a pretty typical contribution, he actually could continue doing that for the rest of the year because he'll still be well under his $2,175 if that's all he's contributing. So there's a little bit more flexibility in stopping the payroll deferral for somebody 65. But it certainly is an issue because his contribution limit will be half of what he's otherwise used to. So if Jim is fully taking advantage of the HSA, he would have to stop those payroll deferrals at the same month that he enrolls in Medicare, or he would put too much in. Another little thing that comes up occasionally is Medicare enrolls people as of the first of the month. So if you turn 65 on April 15th, you actually enroll on April 1st. And HSA law looks on the first day of the month to see whether you're eligible or not for an HSA. So if you're eligible as of the first day of the month, you get to count that month for pro rata calculations. Some people turning 65, they think, hey, I turned 65 on the 15th. The rule says I go on the 1st, and I get that month. But the right answer is you don't get that month because Medicare backs up to the 1st, and that knocks out your eligibility. And Bridget brought this up a little bit, but this ability to maintain HSA eligibility after you turn 65. This gets a little tricky, and I want to just run through the law quickly on this. The law makes a distinction between being eligible and being entitled, and I really think it's more a common sense way to look at that as being eligible versus enrolling in Medicare. Only if you enroll in Medicare do you lose the HSA eligibility. And not everybody enrolls in Medicare at age 65. It's relatively common, and there's not a lot of reasons not to enroll, but one reason not to enroll is to maintain HSA eligibility. And as more and more people are learning about the benefits, people like you listening to this presentation are thinking, hey, it's a pretty good deal, especially if I've still got employer health coverage, which is pretty decent. why should I enroll in Medicare? Maybe hold off on that and maintain my HSA eligibility. If you do hold off on that, then you are able to continue to make HSA contributions theoretically for the rest of your life as long as you avoid enrolling in Medicare. But you have to watch out for this because Medicare enrolls you automatically if you start receiving Social Security. So if you start receiving Social Security, you're enrolled automatically. Also, if you work for an employer with fewer than 20 employees, Medicare becomes your primary health plan, and so Medicare would automatically enroll you in that case too. Now, they may not know this, but you need to know that, and you can't enroll in that case either. So that weeds out a few people, anybody that wants to receive Social Security and anybody working at a smaller employer. So if you do enroll in Social Security, the issue comes up of how can you undo all of this? So let's say you started receiving Social Security, now you learn about the greatness of HSA. Do you want to undo it all? And Bridget mentioned this a little bit earlier, but this slide gets to the detail of it. It's not easy to do. The government says it's possible. What you would need to do is contact Social Security to stop Social Security. If you've already received payments, you have to repay them all the money. You then need to contact Medicare and make sure they've taken you off the rolls, and then you also need to repay Medicare for any money that you've been paid. Those things are, I've talked to people who have done it, I've not done it myself. Neither one is easy to do. I think it's not very common, so I think it's easy to fumble around to try to accomplish that, but it is legally possible. The little box in the bottom I think is interesting because a pretty known congressman, Dick Armey, was frustrated by this. He thought that the government should let you opt out of Medicare because opting out saves the government money, but still get your Social Security because they're two different programs. Why can't I get Social Security and save the money, Medicare money? And he tried to get a bill passed, didn't get the bill passed. He also sued the government saying this is ridiculous, but he lost that lawsuit. So we still have this connection. This next thing on having a younger spouse was having a younger spouse is helpful for HSAs because you lose eligibility to contribute to an HSA at age 65 if you enroll in Medicare. But if you have a younger spouse, they don't. And a lot of people think of HSAs as a family HSA. The HSA law actually refers to family contribution amounts versus individual contribution amounts. There's a little bit of a problem with this that people bump into, though, is the HSAs are built on the individual retirement account model. So all HSA accounts are individual accounts. There's no such thing as a joint account. And it doesn't really matter for most things, and most people think of it as one account, and it works pretty well. But when you get to 65, it does matter. So what often happens is the person that works let's assume there's a non-working spouse because the example I think is more illustrative that way. The person who works opened an HSA maybe years ago and they've been contributing the maximum for years. They turn 65. Their employer maybe talks to them, maybe they know the rules, they enroll in Medicare, they can no longer contribute. They have a younger spouse, and the younger spouse actually, if they continue on the company's health plan, they have a family high deductible health plan, they'll still be eligible to make a full family contribution. But that contribution has to go in the younger spouse's account. So if he or she doesn't have an HSA, they'll have to open an HSA. It's not a big deal, but it can be a slight frustration to people that don't want to have one more banking account. A bigger frustration will be if the employer is giving free comparable money into the employee's HSA, they cannot give it to a spouse's HSA unless the spouse also works there. But let's assume that's not the case. That money they just need to forfeit that money. Also, if the employer allows payroll deferral into an HSA, you can't do that from one spouse to another spouse's HSA. So the employee that works there and continues to work has now reached 65. He's not eligible to continue payroll deferral after he loses eligibility and maximizes his contribution for that final year. He cannot direct the payments be made to his spouse's HSA. So the spouse would have to do that on their own. The catch-up contribution is also lost. They may have been taking advantage of two catch-up contributions in the past. That would require two HSAs to do that, but the person who turns 65 will no longer be able to make the catch-up contribution. Some other age 65 and a half contribution issues. If you go on, the worksheet I mentioned earlier is just shows a quick picture of it, but that's available on the website. We wanted to make sure you understood about calculating age 65 contributions from a pro rata perspective. I talked about pro rata earlier. If you lose eligibility in July, you get half the year. That same rule works for catch-up contributions. So the catch-up contribution is set by law at $1,000. That'll never change unless the law changes. So if you're eligible only 6 months of the year, you get half of that, or 500 of the 1,000, and you'd have to do the math if you are eligible for a different parts of the year. The reason this one I think people get confused on is because the catch-up contribution works the other way when you first turn 55. So as long as you turn 55 sometime before the end of the year, so the extreme of that would be you turn 55 on December 31st of the year, you get the full $1,000. So there's no catch-up pro rata calculation for somebody just turning 55, but there is for somebody losing eligibility. They need to lump that money in with their other eligible limits and do a pro rata calculation based on the number of months of eligibility. And Jim, I think you wanted to help us with an example on this one.
Yeah, we've got the example of what happens, when you are turning 65, you're enrolling in Medicare, but there's also, and this is a good one, you'd think what Jim could do is he could contribute up to 11/12 of his allowable contribution. But there's one little trivia, and this is in Medicare.gov, is that if you delayed Social Security until, let's say, December, and you are not enrolled in Medicare, but if you all of a sudden took Social Security, there is a look-back period of 6 months, and that is considered that you are going to be enrolled in Medicare Part A coverage. So in that case, in this example, you would have thought Jim could do, 11, 12, or 5 months worth, and that's how the calculation would be. I would have thought I could have calculated 11 months worth because I was turning 65 or rather collecting Social Security in December. But that look-back period of 6 months would only result in me being eligible for a 5-month calculation. This is very tricky stuff. It's very obscure, and it's actually on the Medicare.gov website. So it's a caution for people who have delayed Medicare but then later enroll in Social Security. You got a 6-month look-back period.
We wanted to just spend a minute in bringing you up to speed on the domestic same-sex couple issue, domestic partnerships or same-sex couples. Over the last few years, we've had 2 important Supreme Court rulings. In 2013, the Defense of Marriage Act, which went into play under Clinton, said that you can only have 1 man and 1 woman was the definition of a marriage. That was important for HSA law because HSA law gives spouses special benefits, and a spouse had to be the opposite sex. In 2013, the U.S. Supreme Court struck down the Defense of Marriage Act. Then in 2015, the Supreme Court said that all states must allow same-sex marriages. So today we're in a situation where you will probably see a same-sex marriage that has an HSA. And we want to just tell you quickly what that changes. First off is a same-sex couple must be legally married. That must be allowed in all 50 states now, but it doesn't mean it automatically happens. Same-sex couples might still stick with a domestic partnership. They may just live together. There's lots of different ways they may characterize that relationship. If they want the benefits of spouse under HSA law, they have to legally marry. And what are those benefits? I think people kind of forget. They aren't great, but there are some benefits. You can use your HSA tax-free to pay for medical expenses of your spouse. If you're in a domestic relationship, you can't. Your domestic partner is not your spouse, that you can't use your HSA to pay for their medical expenses. If you name a spouse as a beneficiary, they get to treat the HSA as their own upon death. Non-spouses, the domestic partner, wouldn't have that benefit. Divorce, too. There's some special benefits with divorce that a domestic partner would not get. Estate tax treatment treats spouses a little bit more favorably. A more complicated one, but an important one, is the family high deductible policy rules say that if one spouse has a family high deductible health plan, they're both deemed to have family high deductible health plans. That's a special rule built in to stop a couple from getting more than the family contribution limit. Without that rule, you could actually potentially get double the family limit. Well, domestic partners are entitled to get double the family contribution limit right now. Each same-sex domestic partner can contribute the family limit plus the catch-up if they're over 55. That loophole will be closed for any domestic partners that choose to marry. The final thing is you can use your HSA for a child of a former spouse, so that would help if the same-sex couple were in that situation. The testing period applies to age 65-year-olds. They're going to generally fail their testing period. This is a pretty complex area, and we actually have a testing period worksheet on the next slide. And I would just suggest if somebody brings up a testing period question, refer them to our worksheet. It's pretty good. I don't think it's an issue you need to worry about very much, as long as people, really the only time it comes into play is if somebody just started their HSA when they were 64, and then they fail their testing period when they're 65. For anyone that's had an HSA for a number of years, if they fail their testing period, it's not a big deal, and that worksheet would explain why.
Very good. Thank you, Whitney. Our next piece goes into the use of HSAs for Medicare premiums. There's a startling statistic out there. Back in 2000, there were 39.7 million Medicare beneficiaries. How many do you think there will be by 2030?
Yeah, and looking at that slide, look at the dramatic demographics there. By 2030, we've got 81 million people who will be in that comparison. Now, adding to that, remember I said that we've got all baby boomers will be 65 or older in 2030, which will represent 18% of the country. So you can see the pressure that Medicare is going to have in the future. Looking at the next slide, again, we're going to wrap this up. What types of insurance can an age 65-year-old HSA owner pay with their HSA? And as we reviewed in the past, we know Medicare Part B is certainly possible. Again, yeah, usually that's free, that premium, but if you're in long stay at the hospital, there can be cost to that. Medicare Part B, which we kind of illustrated, there's going to be that's the outpatient health care, hospitalization treatments, it's the doctor treatments. It's based on a national average. Generally pays 80% of that. And Part B will likely inflate at 6% per year. And if you're using your 401k, you know that can go into those different kinds of income, which is going to be means tested. So you could pay a higher premium for that. Part C, which is again private insurance that replaces Part A and B, and possibly D. And finally, Medicare Part D, the prescription drugs. So all that could be paid out of your HSA piece. The employee health plan, employee share of premiums for employer-sponsored health care, including premiums for employee-sponsored retired health care after age 65. And one thing you need to be aware of is Medicare supplement insurance is not allowed to be paid from your HSA. If you do, you simply pay ordinary income tax on that withdrawal, but it will not be tax-free.
Medicare payments are automatically deducted from Social Security. I think Jim mentioned this earlier. So they're really, sometimes people get confused. All you have to do is write a check from your HSA to reimburse yourself for that premium if you want it done tax-free. This next slide is kind of a nit, but it can become an expensive nit if you make a mistake. I said earlier a huge benefit of an HSA is you can use your HSA to pay for Medicare payments, but you can also use it to pay for health insurance premiums once you're over 65. For some reason, the IRS rules say you can't use your HSA to pay for the health care premiums of a spouse that's over 65 until you're over 65. So once you're over 65, then you can use the HSA to pay for both yourself and your spouse, but just something to look out for. You must be over 65 to use the HSA to pay for the Medicare premiums. And that's really, the other ones I think are on there are important too, but I think that's the one I wanted to cover on this slide.
Okay, wrapping things up. Again, employer-sponsored health insurance cost the employers in 2016, they're projected to be $266 billion. And the cost as we turn 65 and enroll in Medicare will add more pressure to the Medicare component. Again, as Whitney had talked about, the HSA is a powerful tool to pay for medical expenses during retirement and particularly for the ongoing Medicare premiums. The longer we live, we know that cost is going to keep going up. I love the portability of an HSA product. You can move it to another custodian of your choice when you're retired. And as Whitney also illustrated, these dollars are not subject to required minimums, but a long-term period of asset accumulation that you can do. And with people living longer, certainly there'll be more pressure on their Medicare entitlement. Finally, we also know, as Whitney mentioned, spouse beneficiaries can always treat it as their own and continue to keep it as a tax-deferred basis. Always, if you can, contribute the maximum. That would be a great possibility to let this thing grow. I still argue contribute to your HSA first to max it out and then work on your 401k. Obviously, you want to get a match because that's free money. Remember, when spent on medical expenses in retirement, if you're using taxable dollars, that's going to go into means testing, and you could be paying a higher premium to the Part B and D. Again, because they are taxable, that's where you're going to have those means testing. The HSA, of course, is tax-free. Beginning in 2018, they say these income tiers are going to be adjusted downward to be actually making more retirees paying a higher Medicare premium. So retirees certainly have to pay more for comparable health coverage in retirement when they are working. So again, it's 100% of their responsibility for the Medicare Part B, D, the supplemental, the out-of-pocket expenses, hearing, vision, and dental. You know, boosting a person's portfolio to include Magi, reducing investments, products can save thousands of dollars over the lifetime of these Medicare surcharges. So a lot of possibilities. Again, we want to thank everyone here for joining us, Whitney, Bridget, Stacy, for participating in this seminar today. This concludes our seminar on healthcare costs in retirement. I want to thank you again for joining us.